It's about to get worse as stocks are going to get crushed. I'm your host, Steven Van Metre, and thanks for joining me today. And while investors are eagerly buying every dip, hoping for a big bear market rally, Morgan Stanley is now warning that stocks are going to crash even more than they thought as second quarter earnings loom, and the predictions are not good. Let's over to Morgan Stanley where we start today's story as weekly warm-up, the moment of truth or denial. And with interest rates and equity risk premiums starting to reflect the growth slowdown more accurately, the direction of stocks from here should be mostly about earnings. Second quarter results should shed some light on the outcome. Today we look at where the risk is from the most and least significant. And interest rates, one of the first and most important topics, continues to fall despite still elevated concerns about inflation, and a Fed that remains committed to doing whatever it takes to squash it. Let's be clear, our intermediate term view is and has been that any fall in rates should be interpreted as more of a growth concern rather than potential relief from Fed and inflation pressures. And this is something we've talked about on the show, that interest rates, particularly the long end, when we talk about interest rates, we're talking about the long end of the curve, not the front end. But what happens is the long end is a function of growth and inflation expectations. And when growth comes down, where do interest rates do? They fall. And then, of course, what happens last as a lagging indicator, inflation is to follow. And what Morgan Stanley is saying here is that rates are not a function of inflation, but if they're falling, they're indicating that growth is headed down. And it is in a big way. And here you can see the Treasury yields catching up to the data, but there's more to go. And what they're showing here is the U.S. Economic Surprise Index. And this is an index where it measures if analysts and experts get their predictions right about the economic data. And what they're saying here is the move is to the downside as analysts are getting their predictions wrong. And when you compare that to the 60-day change in the 10-year U.S. Treasury yields, what it indicates is that yields have a lot more space to go down. And speaking of the data, last Friday we got the closely watched ISM Manufacturing Purchasing Manager Survey for June. The survey is important because it's such a powerful relationship with the S&P 500, as we've been talking about, particularly with these Fed surveys, while providing a great coincident leading indicator for the economy. The headline index has been falling for over a year, and for June, the headline reading came at 53, which is still much in the expansionary territory. Now let's quantify that, because 50 is unchanged from the month before. So what 53 means, it is somewhat of a slight expansion over the prior month. So we're absolutely continuing to expand, but the rate of the expansion is slowing down, and that's important. During a mid-late cycle slowdown, this is about where the index would stop going down. Furthermore, the S&P 500 is trading right where it should be based on this PMI reading. But for how long, and that's the question, whether it's done going down. For answers, we look at the internals of the survey, orders and inventories. Now, why do orders and inventories matter? Well, think about this. If I had a widget shop and I was a widget retailer and I was piled full of widget inventory, well, what am I not going to need? More widgets. And so what's going to happen to my new orders? Well, they're going to go down. Now, if my my inventory is moving, if I have a lot of inventory, but I have a lot of sales and it's moving through the system, well, then my orders would be high. So what they're looking at here is to see what that relationship is between inventories and new orders, because if inventories are high and not moving, then what we should see is new orders collapse, and that tells you where the manufacturing sector and the economy are headed. On that score, the data is not encouraging for those looking for a soft landing. Instead, it's indicating the headline index is likely to fall further. And based on that history, if we are going to end up in a recession, our bear case, it's very likely that the PMI would eventually fall to the low 40s, which would be a significant contraction. And if we overlay that outcome onto our S&P 500 versus PMI chart, which we'll look at momentarily, it suggests we could reach 3,000 later this year, a temporary overshoot of our bear case point in time from our June 23 target of 3,350. And here you can see the orders minus inventory lead the headline. And where you can see that happening is the orders minus inventory in blue heading down, telling us the headline PMI index is headed lower. And what does that mean for the S&P 500? Well, that means a potential target of 3,000, which is far lower than most experts think right now. And where the earnings risk into the quarter as Morgan Stanley continues? Well, heading into earnings season, our focus is on forward earnings expectations, earnings revision breadth, and which industries look more or less at risk of downgrades from the top industry standpoint. As their data shows, the S&P 500 and NASDAQ 100 forward earnings estimates are both 20% above the post-Great Financial Crisis trend. As we have discussed in recent weeks, several leading signals point to forward earnings expectations decelerating in the coming months from these elevated levels, as we've covered on this show. Importantly, earnings revision breadth, which often leads forward dollar EPS, is in negative territory and has decelerated even further in the last few days. We think the second quarter earnings season should drive estimates lower, but that it will ultimately take more than one quarter for forward estimates to find a new low. But what data we're looking at says things are going to get a lot worse here, and earnings are coming down along with profits. Now let's take a look at what we've got here is the new orders index from the Philly Fed. And what I like about the Philly Fed is it's got a ton of data compared to some of the other regional Fed data points. Now we don't have the ISM in the Fed database, so we can't use that. But what we can do is overlay corporate profits after tax. Of course, we know that if profits are going down, that means earnings have obviously gone down. And we put that on a year-over-year rate of change and we overlay the two. What do we notice is that when new orders go down, it starts to lead profits starting to fall. In some cases, profits are already starting to fall. But you see new orders going down, profits are already very weak and in contraction. New orders, now profits falling, new orders slowing, profits falling. It gets a little more exaggerated. You can see the relationship gets tighter as time goes by. You see orders rising. You see, of course, down here, profits on a year-over-year rate of change increasing, new orders down, profits down, and that's telling us new orders down, profits are headed with it. And it's not just that, but it's also a function of the Fed's balance sheet, as we've looked at before when we overlay the monetary base on a year-over-year rate of change. Notice now we see profits again on a year-over-year rate of change following the Fed's balance sheet lower with a lag. And that's important because what it tells us that all these earnings estimates, all these targets of the S&P 500 and where it's going, they could be all wrong, and they could be to the high side, because if the Fed continues to tighten, which they're likely to continue to do, at least for into, say, September, they're likely to continue. Maybe they pause then. It tells us the downside risk of the market is huge, that because so much liquidity is getting pulled out. Now, if you're concerned at all about any of this, well, you shouldn't be when it comes to your portfolio. I'll put a link up here to Portfolio Shield, a strategy that just re-hedged its downside risk, because it, like Morgan Stanley, is saying, look, if bond prices are going to head higher and rates come down, it's because financial conditions are tightening. It knows that, and this is when it shines. I'll put a link in the description below. Same strategy that Jeff Snyder just switched firms because he believes in. Now let's continue on, because things overseas are adding to the troubles of how much things could get worse. Bank of England tells lenders to brace for economic storm, as the Bank of England warned on Tuesday that the economic outlook for Britain and the world had darkened, and told banks to ramp up capital buffers to ensure they can weather the storm. The economic outlook for the UK and globally has deteriorated materially, the BofA said as it published its latest financial stability report, adding the developments around the war in Ukraine would be a key factor. And British banks were well placed to weather even a severe economic downturn, said the BOE, although it noted their capital ratios, while still strong, were expected to decline slightly in the coming quarters. Now, this is a little bit different picture than we've heard from the Fed, who said overall the U.S. banks are in great shape, no concern of an economic downturn. But here in Britain, they're saying, hey, wait a minute, we're concerned of things slowing, and we think something needs to be done about it. And that's the bigger part. They're not just saying something's wrong, they're telling the banks they need to make a change. And what change is that? The members of the Financial Policy Committee confirmed that the BOE will double the countercyclical capital buffer rate to 2% July next year, and said it could vary the rate in either direction depending on how the global economy pans out. Now, if you're wondering what this countercyclical capital buffer is, it's designed to counter pro-cyclicality in the financial system. When cyclical systematic risk is judged to be increasing, which clearly the Bank of England is saying is happening, institutions should accumulate capital, which they're going to force the institutions to do, to create buffers that strengthen the resilience of the banking sector during periods of stress, when losses materialize. And so what happens now is banks get forced to buy bonds. And that's what will happen eventually in the US. And what we'll eventually then see is banks starting to build their capital buffer. Well, how do they hold their capital? How do they hold their savings? Well, they're going to do it in the bond market. And that's how we know that eventually banks are going to come back and be even bigger buyers of bonds than they have been. Let's take a look at the data today, because there's something peculiar about it. As the US data, the government data says higher, but the survey data says it's going to be crashing. U.S. factory orders surprised to the upside in May despite a collapsing ISM. After decelerating in April despite plunging manufacturing PMIs, analysts expected U.S. factory orders to reaccelerate from plus 0.3% month over month to plus 0.5% month over month in May. And they were right, as orders soared whoppingly 1.6% month over month, the 8th straight month of rising orders. And yet, it's in complete disagreement with the manufacturing PMIs. And here you can see if the PMI and the new orders here, both in kind of pink and in red, heading down. And here it is, just kind of this outlier, the government data, the manufacturers' new orders heading higher. And it kind of makes you wonder, what the heck is going on? But when we look at this, now we'll overlay again that Philly Fed new orders data. And notice when we put the manufacturers' new orders, again, this is not on a year-over-year rate of change, but actually just the millions of dollars. What we see is something very interesting, is that early on in the kind of 90s here, there really wasn't a tight relationship. But starting in the 2000s, you'll notice that when new orders start to rise here, what happens is that brings, of course, when the Philly Fed new orders rise, it's bringing the manufacturers a headline number higher. And as Philly Fed's data slows down, of course, we see, of course, the government data fall with it. And now it gets pretty tight relationship. But here we see new orders outright falling as manufacturers' orders continue to rise. And what that's telling us that there's going to be a sharp reversal in the data at some point in the near future. And of course, when we look at the equity market, we talk about this wealth effect. It gets even more clear because we'll overlay the Wilshire 5000 in red on a year-over-year rate of change. And you notice that when it comes down, what happens? New orders with a lag come falling down as almost manufacturers are in denial that there's going to be a slowdown in the economy. Here we see the equity market falling, telling us that we're in the not too distant future. New orders are going to come crashing down. Rates are going to come crashing with it. And the economy is going to go all together. And that, of course, could overshoot Morgan Stanley's 3,000 target and take the market even lower. I'm your host, Steven Van Metre. Thanks for watching. Thanks for being fans. Bye now.